We're just moments away from the start, or minutes from the start of the European trading day here. I guess CPI hangs over these markets as the big set-piece event.
Absolutely, it's CPI, and then, of course, the Treasury auctions. There's a 10-year today, a 30-year tomorrow. So I think that there's a little bit of bias towards yields to rise, but that's obviously with no kind of prior knowledge about what CPI will print. I also think there's a little bit, but probably bias for stocks to go down at the margin, but not very strong. In terms of that, there's a soft CPI print. It'll be about softer readings and services dominating the goods inflation, whereas if it's a hot CPI print, well, the jump in yields will pressure stocks. But I still feel that overall we're kind of in limbo. We're looking for the next driver. So we get CPI and auctions, but they don't feel like they're the big macro change. We're waiting to get clarification on what the real trade story is, and I don't think we've got that yet.
Mark, on that 10-year auction and then the 30-year later this week, how much has been priced into the markets in terms of the deficit and debt concerns of the US as that bill works its way through the Senate? I mean, I guess, how much further is there to go, potentially, for yields higher at the long end?
I think long-end yields will rise significantly further over the next year. I think that the backdrop is increasing kind of fiscal and debt concerns in a slowing growth world. But that's very much a long-term picture. I think in short term we haven't necessarily priced loads. But that makes sense. Remember, this is, it's negative carry to just kind of short bonds. So you want to wait for the catalyst and the impetus. It is much better to kind of wait for the negative headline and then trade it aggressively. And we've also got so much uncertainty about the tax bill, the fiscal side, that people don't want to rush that trade. But I think whatever happens, we are going to be kind of worried about the yield situation over the year ahead. It might just be worried about the long end. If we have very aggressive fiscal expansion, it might be worried right along the curve. But I don't think it's a theme to play too aggressively just yet.
OK, yeah, something to watch, though. Mark, did you have high expectations that we would get tariff certainty in the short term? And has anything you've heard from either China-US talks or the latest news lines around Europe, has anything changed your thinking about when we get to the end game?
No, I had very low expectations. I don't think they've necessarily disappointed those low expectations. They might have marginally exceeded in terms of that we seem to be really accelerating. People seem to be making an effort to make a deal. The compromise or the peace between US and China was better than expected. So I think the marginal news flow over the last month or two is good. But the backdrop is tariffs have already jumped massively. The level of tariffs in April, the average effective tariff rate for the US in April, realised average effective tariff rate, was over 7% for the US across all trade partners. For China, it was the high 30s. These are incredible levels. So overall, this is an increasing cost of business and there's an increasing cost to corporates and to stocks globally, particularly in the US.